Okay, well, welcome to the webinar. My name is Jason Nord, and I'm the Director of the Tax Increment Financing Division at the Office of the State Auditor. And today I will review the 2023 changes made to the TIF Act. The 2023 changes were enacted in Laws 2023, Chapter 64, Articles 8 and 9, and the majority of those changes were provisions that were proposed by the Office of the State Auditor. We have had conversations for at least a couple of years with stakeholders about a variety of difficulties with TIF law. And 2 years ago, we pulled together a TIF oversight and administration discussion group that included county, city, and school district representatives, people from revenue, House and Senate staff, and some TIF practitioners to get some feedback on proposals to address some of those problems. And we worked through the issues to mitigate concerns and garner support for the proposals. I think it's a process we'll continue to use again and for future clarifications. But I want to thank the participants that gave their input and helped refine these changes. The changes covered three main areas: administrative expenses, the TIF Act's violations statute, and various pooling provisions. Our goal was to mitigate ambiguities and improve the ability of authorities to understand and comply with the TIF Act, and to improve our ability to provide oversight. We didn't have any specific agenda for policy changes, but in order to clarify some things, we did have to go beyond just technical issues. And there were then some significant changes that are critical for authorities to understand. And aside from these three areas, there was three other miscellaneous general law changes and a number of special laws that apply to certain authorities or certain districts. And let's actually start with the miscellaneous items and special laws first, so we can save the most detailed topic, the pooling changes, for last. First, a definition was added for pay-as-you-go notes or PAYGO notes as part of our recommendations. Prior law did not have such a definition, and they get referred to a lot in the changes we're making to the 6-year rule. So we did add one as subdivision 30 of the definition statute. A pay-as-you-go contractor note is a written note or obligation that evidences an authority's commitment to reimburse a developer, property owner, or note holder for costs of activities, including any interest that they occur. It makes reimbursements from tax increment revenues that are identified in the note, and usually that's from specific properties. As taxes are paid and the revenues are received by the authority and municipality, and because property taxes are due in two halves each year, that's typically expressed as payments as of receipts by dates that are 6 months apart. So it's pretty common to see like February 1 or August 1, something like that, as the reimbursement dates. And then these are also notes that are where the risk of the insufficiency is borne by the developer, owner, or note holder, rather than a traditional bond, where the risk would be on the authority. PAYGOs have become the most popular type of debt because, sorry, forgot to pop that up. PAYGOs have become the most popular type of TIF debt because the risk of insufficient increment is borne by the developer rather than the authority, potentially having to levy to pay bonds. All right, next, we also asked for a small change to reporting requirements. We mostly have discretion in identifying the content of annual reporting, but there are certain items that are actually statutorily required. And one of those has been a requirement to include both the month and the year of the first receipt of increment. The month is no longer meaningful. It had been relevant years ago when mid-day certification requirements were an issue, but now as we're doing some planning for future reporting changes, we plan to only ask for the year and not the month, and so we just asked for this change. We are working on reporting form changes, but it'll probably be a couple of years before we see that. And then the last miscellaneous change here was not our proposal, but was sought by various cities to change the qualification for the small city exception that permits the use of TIF for commercial development. Under prior law, only cities under 5,000 that were more than 10 miles away from a city with a population of 10,000 or more could qualify. And in the law this session, the distance parameter was reduced from 10 miles to 5 miles. But one important thing to note is that's not driving distances. Those are straight line, kind of as the crow fly distances from border to border. So All right, and then there were special laws for a dozen specific authorities that had requested them, and this is a list of those authorities, and we're not going to get into the details of each, but if you're one of these authorities, you should look for those if you're not already very well aware of what the contents of those changes were. And before I move on to kind of the three main topics, let's do a quick poll question. And the question here then is, which of the following statements is true about economic development TIF districts? A, they can always be used for commercial and retail facilities. B, they can never be used for commercial and retail facilities. Or C, they can generally only be used for commercial and retail facilities under the small city exception.
About 2/3 of people think it's that last option.
All right. You are correct. So that's kind of the main issue. Normally, economic development districts are limited to more like manufacturing, warehousing type uses, and the small city exception is what allows kind of more small cities, distance from population centers to be able to use it a little bit more openly for other things. Okay, that was. Let's move on then to administrative expenses. Um, there are three changes that were made this session as part of our recommendations. The new law was clarified the definition of administrative expenses. We clarified the calculation of the administrative expense limit, and we added an exception to the administrative expense limit. So looking at the definition of administrative expenses, prior law had defined administrative expenses as all expenditures of an authority other than, and then it listed certain development activities. And this description of what they are not left a lot of room for ambiguity. And at times we wished we could more clearly identify examples of things that are indeed administrative expenses. So the new law now identifies non-exhaustive lists of both things that are and are not administrative expenses. And when we talk about administrative expenses here, we're only referring to the definition of authority admin expenses, not the county admin expenses that counties can require to be paid from tax increments. So here then are the items that are now expressly included as admin expenses. Services of bond counsel, fiscal consultants, and economic development consultants are admin expenses. The allocated staff time for administering a project, like preparing a TIF plan, negotiating agreements, accounting for segregated funds, annual reporting, and monitoring compliance, are admin expenses. Publication costs for annual disclosures and notices are admin costs. And this next one is an important clarification stemming from discussions we had between our office and cities and TIF professionals. There's one point where we were concerned that maintenance and operating costs for properties purchased with TIF weren't eligible TIF expenditures, as that could potentially open the door to funding city services with tax increment. But we did come around to agree that the usual and customary maintenance and operating costs, including any necessary reserves for repairs and insurance costs, could be paid from tax increments, especially since it's really the lease proceeds of those properties that are logically the revenue source that should cover those costs, and those lease proceeds are defined as tax increment. There was concern, however, about classifying them as admin costs because they would have to compete with other costs within the admin limit. And these costs can sometimes be significant. So here we've expressly defined them as admin costs, but when we look at the changes to the admin limit in a moment, you'll see we adjusted for this situation. Continuing here, the cost to prepare development action response plans, which are relevant for soils condition districts and hazardous substance subdistricts, are admin costs. And lastly, admin costs include amounts to pay bonds, interfund loans, and other obligations to the extent that those obligations were used for this list of costs. This last one is kind of an important clarification because under prior law, there was the potential for some ambiguity about whether financing the costs could make them no longer administrative costs. I don't think anyone ever thought that or raised that, but we kind of noted that potential in the way it was written, and so we've drafted it to avert any such confusion here. Okay, the list of items that are not included as admin costs is largely the same as it had been under prior law, with a little bit of clarifications that we'll note here. So amounts to purchase land and buildings are not admin costs, and we had added the or buildings part here to clarify this. The next item is essentially the contracting of the physical development activities, but we added, there's a few examples listed, and we added a few of those examples to help clarify. Relocation benefits remain the same as not, and then we added property taxes or payments in lieu of taxes as not being administrative expenses. And there's been some questions about whether these costs can even be paid with tax increments at all. And the answer to that may depend on the various developments, what the various development statutes have to say. But in any case, they wouldn't be admin costs. And then lastly, amounts for principal and interest on bonds or other obligations that are for the listed development costs are also not admin costs, where we clarified that the financing of admin costs remains administrative expenses. So, okay, so now turning to the changes to the admin expense limit, let's first recap what the limit has been and largely continues to be. There are separate limits expressed for older districts and newer districts. Districts with certification request date before August 1st, 2001 have a limit of 10% of the total estimated expenditures authorized in the TIF plan or total tax increment expenditures for the project, whichever is less. Whereas districts with a request for certification date after August 1st, 2001 have a limit of 10% of the total estimated expenditures authorized in the TIF plan or total tax increments, whichever is less. The total tax increments referenced here includes only the distribution of tax increments collected by the county auditor and any TIF credit reimbursements you might receive. This is a distinction that's going to come up again under pooling. The TIF Act definition of tax increments includes 5 different clauses. And the first is increment that's generated by the captured value. And so that's the distributions from the county auditor and any reimbursements of TIF credits. The other 4 clauses in the definition of increments talk about other things like interest earned on increment or lease and sale proceeds and those types of things. So the admin limit for the newer districts, which has the total tax increments component to it, that's only based on those clause 1 increments and not the broader definition. However, the limit applies to the uses of all tax increments. So even though like interest earnings, for example, don't help set the limit, the use of all increments for admin expenses must stay within the limit. So the new law makes 2 clarifications. The first, the 10% limit was written in a potentially confusing way for both the older and the newer districts, where you might have wondered if it was just 10% of the expenditures authorized in the TIF plan or 100% of the project costs or for the older districts or the clause 1 increments for the newer districts, even though that wouldn't make any sense. So we just inserted 10% in front of the second measure in each case to help avoid that misunderstanding. And that's always been the rational and understood meaning. Nobody's ever suggested otherwise, but we preemptively just tried to clarify the language, which never hurts. Second, there was no prior guidance as to how returned increments should be regarded when calculating the admin limit. So if you got $1 million of increment and you returned 100,000, how does that affect the calculation? So that the new law clarifies that the measure of total tax increments should be net of amounts returned to the county auditor that are returned because they're excess increments or because they were distributed after decertification, as we'll see under the 6-year rule, or because they were remedies for improperly received increments. So in other words, the admin limit, like the pooling limit, which we'll discuss later, should only be based on kind of the authorized properly received increments. All right, let's look at a quick example of this. Say you have a newer district that's subject to the newer limit and the total estimated expenditures authorized in the TIF plan was 250,000. But in the end, you only received 210,000 of total increments. But you returned 15,000 to remedy some increment that was received because you didn't decertify in a timely manner. The total increment for purposes of the limit should be net of the return amount. So here there was $195,000 of authorized and properly received tax increments, and that's what the limit will be based on. So 10% of this amount, or $19,500, is the lesser of 10% of the 250,000 in the TIF plan, or this 10% of total increments. So 19,500 is the limit. And if the district had used $24,000 of tax increments for admin expenses, it would be a violation of $5,000 or $4,500. So please be aware, that was within the 10% of what was in the plan. So be aware when you're tracking your admin expenses that even though you might be within your plan estimate, you do need to continually monitor the limit over time appropriately. All right, now earlier I mentioned that we added an exception to the admin expense limit, and it's in relation to those usual and customary maintenance and operating costs. These costs, along with the reserves for necessary repairs and insurance costs, could easily become significant amounts and are perhaps best paid from lease proceeds from the property. But as I said before, those lease proceeds are tax increments. So an exception to the limit was made for the use of the property's lease and sale proceeds that are used for these maintenance and operating costs. So the uses of that source of increments are excluded from the limit. And if to further appreciate this, if we revisit the same example we just looked at, but we note here that in addition to the 210,000 of total increments that were distributed from the county auditor as collections of tax increments, and remember that's those are the limits increments that are used to set the limit. There was also $42,000 of tax increments from lease proceeds. So if 10% of the $24,000 of admin expenses came from that $42,000 of lease proceeds and were used for the maintenance of the property, then only the remaining $14,000 of admin expenses are subject to the limit. And in this case, there would be no violation because that 14,000 fits within the $19,500 limit. So yeah, when you're using that, kind of appropriate source of increment for those costs, they are an exception to the limit. So given these changes related to administrative expenses, what are some suggestions or implications you may wish to consider? First, irrespective of the changes, it's wise to track and document and report all administrative expenses. You cannot just take a 10% cut for admin and call it good. They have to be actual documented costs. And now you have improved definitions to reference when you're trying to identify what expenses may qualify. And now it's wise to keep separate track of the use of lease proceeds for maintenance and operating costs because you'll be able to exclude them from the limit. So you'll want to start keeping separate track of that. This is something we may actually add to the reporting forms here fairly soon. You should also monitor admin expenses and limits as you go along. Violations are evaluated upon or after decertification. So you might be okay being over the limit initially. A lot of those initial admin costs come right away before you get any increment. But all that matters is that you're within the limit by the end. And if increments end up coming up less than expected, those early costs might be over the limit. So remedy any violations of the limit that do result. Actual increment stream, as I said, actual increment streams can sometimes be much shorter than what was planned for. And then lastly, use comments on the reporting form to explain those kind of remedies and issues that you encounter. Okay. All right, very good. Well, let's do another poll question here. This one will be a true or false question. So tax increments from interest earnings can now be spent on maintenance and operating costs without being subject to the limit. Is that true or false?
Okay, so about 2/3 of people thought that this question was false.
Okay, that is correct. Only tax increments from lease and sale proceeds can now be spent on maintenance and operating costs without being subject to the limit. So if you're using regular increments or interest earning increments to pay these maintenance and operating costs, those are still have to fit within the limit. But if you're using sale or lease proceeds for the maintenance and operating costs, then they're not subject to the limit. So make sure you track that.
And I did see a question come in here as well.
I think I see it here. It's what is the effective date for these admin provisions? I believe all of them were effective the day following final enactment. So that would have been May 25th, roughly, of 2023. Later on, I'll talk about there's one provision relating to the 6-year rule changes that had a slightly different effective date, but I'll talk about that under pooling. Okay, let's then move on to the changes we made to the violations section of the TIF Act. Each of these is largely a technical clarification rather than any change in policy or meaning. First, there was an obsolete sentence that we deleted in the provisions that talk about remedying the improper receipt of increment. That sentence had referenced duration limits in a manner that was inconsistent with actual practice and conventions. It sort of seemed to assume that counties would be monitoring the 6-year rule and would be flawless in decertifying districts in a timely manner, and that distributions after required decertification would never be an issue. But in practice, it's authorities that are responsible for following the law and decertifying in a timely manner, and failing to do so then results in a violation by improperly collecting extra years of increment. So we deleted the confusing sentence just to remove any of the potential ambiguity. The second change is just kind of a streamlining. The language that talks about withholding tax increments for failing to submit annual reporting was simplified. That provision at one point in time used to be more complicated, and many years ago they changed it to simplify it, but they missed an opportunity to trim a whole bunch of extra language. So this was purely just a technical streamlining of language to get rid of a lot of extra words and say the same thing in a more efficient manner. The third change, there was a statutory reference that was corrected and expanded in the provision that addresses remedying improper expenditures of increment. So the prior law had only referenced the main limitation section of the TIF Act, kind of believing that all of the limits on how increment can be used would be in that section. But there's actually some other limitations in other sections that limit the use of increment. And so the reference was broadened to the full TIF Act rather than just that one section, so that because otherwise violating those other ones would be left unaddressed and create ambiguity and confusion there. So again, we don't view this as we view this as kind of comporting to the original and prevailing expectation rather than creating a change at all. We've just avoided any confusion about that. So these are all pretty technical. Any questions about these changes to the violation statutes?
Not that I see at the moment.
All right, very good. Now let's move on to pooling. But before we dive into the pooling changes, I want to first very briefly overview what pooling is and set the context for these changes, because I realize that many of you don't work with TIF every day, and I don't want to assume that everybody has a full awareness of what the prior laws were and all the different concepts involved. So we're just going to set a little bit of context here very briefly with just a couple slides. TIF districts are created under the authority of various economic development statutes that allow for the creation of project areas. And then TIF districts are created within those project areas and are comprised of just the specific properties that are being developed. And there can be many TIF districts within a project area. Sometimes those project areas are coterminous with the city boundaries, and sometimes they're smaller. But most tax increments are going to be spent on activity in the TIF district itself, but some increment may be spent on activity outside the district, but within that larger project area. And this expenditure of increments inside the district, this expenditure of increments outside the district, but within the larger project area, is something that's commonly called pooling, deriving kind of from the idea that increments can be pooled from multiple districts to pay for other project area activities. So pooling is not a statutory term. You can just simply equate it though with out district expenditures. Now, there are various pooling limits, and these came about because in the very early years of TIF, the legislature got really concerned that a TIF district might be created for one purpose or a specific development, but instead of being decertified when that development was completed, municipalities would take advantage of the revenue stream of tax increments and start identifying other costs and activities that could be paid, and districts would be kept open for their full durations rather than being decertified when the original purpose was accomplished. So they created, so the legislature reacting to that created an overall pooling limit and a pair of rules that work together to promote more focused use of TIF and to promote early decertification. So the overall pooling limit is 25% for redevelopment districts and 20% for all the other types of districts. Although pooling doesn't really apply to housing districts because housing districts have to use their money for affordable housing, and generally use for affordable housing is considered in district regardless of whether it's located. So pooling really isn't an issue for housing districts, but these are the limits for all the other district types. There's also one option for an authority to elect in its TIF plan to be able to pool an extra 10% if that's done for certain, there's specific affordable housing purposes that you can do that for. So a redevelopment district might actually pool as much as 35%, and the other district types might pool as much as 30%. The two provisions that sought to focus TIF usage and promote early decertification are referred to as the 5-year rule and 6-year rule. The 5-year rule defines costs that are obligated after the first 5 years as being out district costs, even if they relate to activity located inside the district. New expenditures and cost obligations after these first 5 years are still allowed, but they have to fit within the pooling limit. So expenditures inside the district are only in district costs if they're spent and obligated for activity that occurs within the first 5 years, and after that they become pooling expenditures. And then the 6-year rule requires annually that the in-district share of increment has to be used for in-district obligations, and requires that when in-district costs and obligations have been paid, the district must be decertified. And that's what drives a lot of the early decertification. The 6-year rule, however, has suffered from ambiguity and some lack of awareness to some of its parts. And so the new legislation is making substantial changes that we hope will be easier to understand and to oversee and to apply. Now, because these law changes deal so much with early decertification, I just want to give a little bit of brief context here as to why that's so important. And this kind of model, you may have seen this in my other trainings, will help illustrate. So the general premise from its redevelopment origins is that a property might be blighted where its value is declining or stagnating, and this is going to continue, but for the use of TIF. So when the TIF district is created, the original value at that point is established or essentially frozen as the tax base for the full duration of the TIF district. And then when the financing is in place and the development happens and the value increases as a result, the tax rate gets applied to that new value, but the taxes on that new value are tax increments above and beyond tax levies. And when the district ends and is decertified, that's when taxpayers get the benefit of the new tax base to support local levies. And the capture in the interim is generally viewed neutrally as making these benefits possible rather than negatively as economic loss, because the development would not occur but for the use of TIF. So recognize that the benefits of a TIF district are delayed until it's essentially decertified. And so if a TIF district decertifies early, once the captured increment has been sufficient to cover the necessary costs for the original purpose, this will maximize the public benefits and allow those benefits to be enjoyed as early as possible. And so the 5-year rule is trying to zero in on what those critical and necessary costs are. The thinking is that you should be able to identify and incur those costs early on, and that costs that are incurred later on tend to be more discretionary. And so that's what the 5-year rule is trying to identify the necessary cost. And then the 6-year rule is requiring that early decertification once you have sufficient increment to pay those costs. And according to our 2021 data, nearly 80% of redevelopment districts and housing districts are decertifying early, and not just by a year or two, but on average by around 10 years. So so that's kind of sets the context for all of these pooling rules, and we can now talk about the changes to those rules. There were clarifications to the overall pooling limit, the 5-year rule, and substantial changes to the 6-year rule, and a technical correction to one little used pooling for deficits provision, which relates to aiding districts that experienced deficits due to property tax reforms back in 2001. Let's actually look at that last technical one first, just to get it out of the way. This provision relates, is rarely used. It relates to the reforms that were done in the 90s and 2001. And the way the measure of a deficit was expressed in this provision was supposed to be one amount minus the sum of two other amounts. But the way it was actually written, it was that it would be the first amount minus the second amount plus the third amount. And that leads to a very different result. As the example here shows, $10 minus the sum of $2 and $3 is $5, whereas $10 minus $2 plus $3, it comes out to 11. So the way it's written is completely illogical, and no one's ever suggested that that was the correct math. So it's simply inserting the sum of, we've corrected the math. And again, this has never really been an issue that we're aware of. And so we've headed off that confusion, hopefully. All right, so let's look at the overall pooling limit, we also had two technical language clarifications here. And neither of these is meant to change anything substantively. They were just meant to avoid or resolve possible confusion. So the first broadened a cross-reference to the statute that allows county admin costs and county road costs to be paid from tax increment. By broadening this reference to the whole subdivision instead of just one of the two paragraphs, it clarifies that revenues used to pay county admin costs, like those that are used to pay county road costs, are deducted before calculating the pooling limit. Prior law just referenced the paragraph that deals with the county road costs, but we believe it's been the general expectation and practice that revenues used for county admin costs are also not subject to the pooling limit. And so know that you can make payments of county admin costs and road costs, and they're not using up part of your pooling limit. And then the second technical language tweak was just a very minor wording clarification. And so neither of these are meant to be substantive, and just providing some clarification. There was a substantive change, however, to the overall pooling limit, and that's the addition of a new paragraph to clarify how the pooling limit is calculated. Perhaps it's best to start with an example that highlights some of the pre-existing ambiguity. Let's say you have a redevelopment district, and redevelopment districts per the pooling limit can spend must spend at least 75% in the district and can pool no more than 25% outside the district over the life of the district. And let's say that this district has collected $1 million over its duration, but the TIF plan had authorized $975,000 of TIF expenditures. So the district ended up having excess increment of $25,000 that it had to return to the county auditor. The authority pooled $250,000 and spent $675,000 on in-district activities, and that left $50,000 of kind of leftover unneeded increment that the authority then returned to the county. Okay, so what questions did we encounter about applying the pooling limit? First, should the limit be based on the million that it was actually received, even if that exceeded the maximum amount authorized by the TIF plan? So in other words, is the 25% limit supposed to be based on the million, or should it be based on the 975,000? Second, is the return of excess increment considered an in-district use, or is it considered pooling? And logically, you might think, well, neither. But because the pooling limit requires 75% to be spent in and isn't just a limit on not spending more than 25% out, you have to determine every dollar's disposition as being either in or out. So that needs to be identified as to whether that's an in-district use or whether that's an out-district use. Um, and then with that in mind, you have to consider, is this okay? Because the amount of pooling, the $250,000 of pooling didn't exceed 25% of the million? Or is this a violation because less than 75% was spent on activity inside the district? And then, like the return of excess increment, the return of any unneeded increments also needs to be considered either in district or pooling. And then, what about the return of any other increments? For example, if you had some expenditure violations or you were remedying the improper receipt of increment, or there's a new provision we'll talk about later that requires money to be returned. So are those returns of increments, are they considered in district or are they considered out district for purposes of uh, identifying compliance with the pooling limit? And so for this example, one perspective might be that there's no problem here because the pooling was not more than 25% of the million. But by another perspective, you could say there was a $75,000 violation here because the amount actually spent in district was less than the minimum 75% or $750,000. So these questions make it difficult for authorities to understand exactly what the limits are, and it also makes it difficult for us to oversee um, that compliance as well. So the new paragraph now clarifies that the limit will be determined after excluding the return of excess increment or returns of any increment that were received after decertification because tax calculations were not stopped in time, which again, I'll talk about under the changes to the 6-year rule, or any payments or returns of tax increments received in violation. So in other words, like the admin limit, the pooling limit will be based on the properly received and authorized increment. The new law also clarifies that the return of any unneeded or surplus increments are considered to be in-district activities, and payments to remedy expenditure violations are not considered in-district uses. So if we return to our example, we can assess how the limit will be applied. First, we now know that we subtract the return of excess increment before we calculate the limit. Therefore, the limit is going to be based on the net amount after returned increment. So it's going to be based on that 975,000, not on the million. And the pooling limit, therefore, will be 243,750, which is 25% of the 975. And therefore, the pooling of 250,000 is actually a violation of $6,250. The $50,000 of unneeded increments that were returned are considered in-district uses of increment. So when we add that to the 675,000 that was actually expended inside the district, you get a total of $725,000 that's considered to be spent in district. And so the minimum required that must be spent in district, however, is 731,250, which is 75% of the 975,000. So there's the same violation here of 6,250, just viewed from the opposite perspective. These clarifications to the TIF Act could be viewed by some people as being more lenient than they had assumed or tougher than they had assumed, depending on what your assumptions might have been about the ambiguity in the prior law. And our goal was not to make things tighter or make things looser. We just wanted to make things clearer so that you know what the limits are and we know how to oversee them. Okay, so based on the change to the overall pooling limit, I'd offer some suggestions for TIF authorities. First, it would be wise to review all of your districts with these clarifications in mind to determine if pooling issues are present or forthcoming as your districts reach or draw closer to decertification. Remember, it's upon decertification when any violations of the limit will be assessed, but you want to kind of prepare and plan ahead accordingly. Second, if you do find violations, be sure to remedy them by making a payment to the county auditor in the amount of the limit violation, and of course, adjust any future expenditures or plans to avoid such violations. Third, get into a habit of annually tracking each district to understand your option for pooling and to gauge whether you're on track to comply with the limit. And lastly, as you have questions, please refer to our updated statements of positions related to pooling and these other subjects that have been affected by the law changes. I will note how that we're still finishing up those updated statements of position. They're not quite posted yet. They'll be coming very soon here in the next few days or week or so. We'll get those posted out there. Well, let's try another poll question then. We just identified that returning surplus increment and not excess increment, but the unneeded increments that aren't required to be returned, that we've just said that those are considered in-district use when they are returned. So the poll question here is, what happens to the surplus increment that is returned? A, it all goes back to the state, or B, it gets redistributed to the city, county, and school district.
Right. Well, overwhelmingly, it looks like people think it gets redistributed.
Okay, very good. I'm glad that is well understood. I think we've heard over at times that people say you don't ever want to return increment and you don't want to just give it back to the state, but none of it comes to the state. All of it gets redistributed back. So whenever you've got increments you don't need, if you return them, you'll get your cut back. And when you do get your redistribution back, it'll no longer be subject to the TIF Act limitations, and so you can use it for any lawful purpose. So perhaps that's a positive option instead of something that should be avoided. Very good. All right, now let's look at the 5-year rule and some of the issues and clarifications that were adopted for it. As I mentioned before, the 5-year rule adds a timing component to define what gets considered in-district activity or out-district activity. And the prior law had read, revenues derived from tax increments paid by properties in the district are considered to have been expended on an activity within the district under subdivision 2 only if one of the following occurs. And then it went on to list the various expenditures and actions that need to occur before or within 5 years from certification. So for example, if a PAYGO contract is entered into within 5 years for the performance of activities within the first 5 years, then payments on that PAYGO would be considered in-district expenditures. But if a contract were entered into after the 5-year mark for activity that occurs later, then the payments on that PAYGO would be considered out-district or pooling expenditures. So what some of the ambiguity here is it clear from this language that in-district activities only remain in-district activities if the timing is met? Or might one think that an activity that's physically outside the district becomes an in-district activity by meeting the timing? And we don't anticipate that anybody viewed it that way, but we thought a clarification would help prevent any such misunderstanding. So here then are the clarifying edits in the new law. It now reads, revenues are derived from tax increments paid by properties in the district that are expended on an activity within the district will instead be considered to have been expended on an activity outside the district for purposes of subdivision 2 unless, and then it lists the same things that need to occur within the first 5 years. So it clarifies that only in-district activities switch to being considered out-district due to timing and not vice versa. And again, this is not viewed as a change, just a clarification. And maybe the one situation that is better clarified here is if you had an interfund loan for admin expenses. Admin expenses are defined as out-district activities with one exception. But they would not be considered in-district just because they happen in the first 5 years. They stay, they retain their consideration as being out-district activities. So. All right, before looking at the other clarifications to the 5-year rule, I just wanted to note something to pay attention to as you're trying to understand the 5-year rule. And when you're looking at which of your obligations might meet the 5-year rule and which ones might not, know that the payment of obligations doesn't have to be made within the 5 years. Obviously, you know, we're talking about financing, so those payments can occur over time. But generally, it's not just sufficient to sign or issue a note in the first 5 years. generally the expenditures or the activities that those notes finance also has to occur within the first 5-year period. So you couldn't just issue a note, for example, before the 5-year deadline for something that's going to happen years later. And check with your legal advisors as you work through the nitty-gritty details if this distinction raises any particular questions. But I just wanted to make a note of that as sort of a general heads up. Okay, there are a few other clarifications of the 5-year rule included in the new law. First, there was just some technical language edits for consistency. Second, there was an obsolete reference to the biotech zones that were repealed, that we removed. And third, there was a reference to 2D pooling for housing that was removed in the 5-year rule language. If you're not familiar with this, this is that provision that that's contained in the overall pooling limit, and the overall pooling limit is subdivision 2. And there's a paragraph D, and that's why we're calling this 2D pooling. For an authority to pool the extra 10% if it elects to do so in the TIF plan for specific affordable housing purposes. That pooling had been defined in the 5-year rule as being in district. But if 2D permits more pooling for housing, which is out district, then why would it also be defined as an in-district expenditure? Because it's not pooling anymore if it's considered in district. And so that duality created confusion. It was generally understood that the reason it was included under the 5-year rule was to prevent the 6-year rule's early decertification provision from limiting 2D pooling for housing to less than its full percentage. So in other words, if the district had to decertify when enough increment was collected to pay in-district obligations, they wanted to make sure that those pooling obligations were included in that measure. And that's why it had been added to the 5-year rule in the first place. The new law deletes the duality though. And instead, there's some new provisions under the 6-year rule that address this subject and accomplish the same result. But it is now just pooling. It's not both in district and out district. Okay, so that's how the 5-year rule was amended. And here's my corresponding suggestions for TIF authorities. First, review your TIF districts to ensure that you understand which obligations and expenditures are in-district versus out-district expenditures. All in-district obligations will be set as of the 5-year rule date because any new expenditures or other payments on in-district obligations after that point will be out-district expenditures. I'm sorry, any new expenditures other than payments on those in-district obligations after that point will be out-district expenditures, even if they're for an improvement that's made inside the district. So it's by year 6, you should be able to fully understand the extent of your in-district obligations. Then annually track your in-district and out-district expenditures so that you can stay in compliance. This is probably the biggest thing that you can do to stay in compliance. Or put another way, it's really easy to fall into a violation if you're not really tracking this carefully, because you can run into pooling violations. So and again, look for our updated statements of position for the 5- and 6-year rule and for pooling, which will be posted very shortly. Let's try another poll question. Okay, so this is another true or false question. So any obligations incurred in the first 5 years are considered in-district obligations. True or false?
About 2/3 of people think false.
Okay, good. Yeah, the answer is false. If an obligation is for an activity that's outside the district, like an interfund loan for admin costs, it is an out-district obligation, even if it's happening in the first 5 years. So the 5-year rule treats in-district activity as an out-district cost if it doesn't meet the 5-year timing, but it doesn't treat out-district activity as in-district just because it meets the 5-year period. So very good. All right. Well, now let's turn to the changes to the 6-year rule. There were major changes to this provision, and we'll cover each in detail. But in short, the new law eliminated the extra annual pooling limitation that had began in year 6. It clarified that the how the early decertification works. It clarifies the treatment of pay-as-you-go obligations. It adds a requirement to remove parcels. It had a grandfather provision for existing bonds for pooled expenditures. It clarifies calculations, it addresses the decertification procedures and timing, and it addresses the availability of increment for 2D housing. So lots of stuff going on here. Also, please note that I understand that this topic is going to get into the weeds a bit, and there's definitely some of you, all of us basically, are going to feel a little bit overwhelmed going through all this stuff. That's how I felt when I was putting it together. And actually, one of the reasons it's one of the reasons why we put together a couple of new videos for you. So if you haven't seen this already, we just posted 2 relatively shorter videos on our website along with a tool. And so there's an 18-minute video that overviews the 6-year rule and these changes. And there's also a 20-minute video that suggests steps for how to monitor compliance with the 6-year rule, along with a spreadsheet tool that you can download to follow those steps that we talk about in that second video. So please check those out. The links are in your provided in the resources handout that Haley had emailed out. So hopefully those will be good resources. But if you start feeling a little overwhelmed here, that I'm talking like really detailed, I apologize for that. It's just I want to be complete and thorough with what the changes were. So feel free to watch this back or check out those videos and check out our statements of position to get clarifications. So with that ominous warning, we'll start with the removal of something positive, the removal of the extra annual limitation on pooling. So because this annual limit, which was in the old paragraph A, has been removed, I'm not going to get too technical with it, but it had essentially said the following. In each year, beginning in the 6th year, if the applicable in-district percentage of tax increment revenues exceeds the amount of expenditures for in-district costs under the 5-year rule, an amount equal to the difference must be used and only used to pay or to fees, and then basically the in-district obligations under the 5-year rule. So this effectively became an annual limit restricting the in-district percentage of increment for each year starting in year 6. And so if the in-district share of each year's increments had to be used for in-district obligations. And an example is going to make this make more sense. So, and we can talk about the ambiguity we encountered. So let's say you have a redevelopment district, and so you have to spend at least 75% in district. And say your TIF plan anticipates there's going to be $2 million of increments, and you're going to pool 500,000. And then now let's say you actually get to year 14, and prior to year 14, the district had received $1 million of increment, and it had spent 900,000 of it on in-district activities, and it had pooled 100,000. So you're entering year 14 with no cash balance because all of your increment so far has been spent. And now in year 6, or in year 14, sorry, you receive $80,000 of increment. So here's another poll question for you. Under this prior law, could you have spent $40,000 on a pooling expenditure in year 14? And while you're thinking about that, I just want to clarify that I'll just note that the $40,000 definitely fits within the overall pooling limit because only 10% has been pooled so far, and that $40,000 isn't going to push it over 25%. So that's not the issue. It's not an issue of whether it fits within the overall pooling limit. But could you have spent $40,000 outside the district if you received $80,000 in year 14?
All right. Well, we are super split on this one. Slight majority for yes.
Okay. All right. Well, and so obviously there's some ambiguity here, right? The correct answer is no. Under prior law, because there was an annual restriction on the in-district share of each year's increment, that meant that 75% of that year 14 increment, so 75% of the $80,000 had to be restricted for in-district purposes. So 60,000 had to be restricted, and only 25,000 could, or 25% or $20,000 could be pooled. So, it would, if you used 40,000 in year 14 for pooling, you would be using $20,000 of the restricted in district increment, and then that would have been a violation. You could spend the $40,000 over 2 years. If you got another 80,000 in the next year, you could do it just fine over 2 years. But if you did it all in year 14, that would have been a violation. And so our view was that the 6-year rules annual restrictions seem to have low awareness among authorities, kind of as demonstrated by the poll question results, I guess. And we saw that violations could be easily avoided sometimes just by making informed timing choices. And we felt it was difficult both for authorities to monitor and for us to oversee, because you're not going to come into every year with the zero balance and be able to easily see what the makeup of the existing balance was. And so we questioned whether this had value as an extra restriction beyond the overall pulling limit, or whether it was just amounted to kind of a marginal restriction that served more as a pitfall than as an important limitation. And so as part of our proposal in the new law, that we did eliminate this annual restriction. And so now it's something you no longer have to be concerned with. So that's a very good thing, I believe. So then the remaining important component of the 6-year rule now is the early decertification requirement. That's, so the prior law had the two components, the annual restriction and the early decertification requirement. Now we just have the early decertification requirement where you have to decertify generally when sufficient increment is collected to pay all in-district obligations. The prior law drafting of this provision had several ambiguities. It read, the district must be decertified and the pledge of tax increment discharged when the outstanding bonds have been defeased and when sufficient money has been set aside based on increment to be collected through the end of the calendar year, the following amounts. And then it referred to the amounts defined as in district under the 5-year rule. But what if sufficient money to defease a bond existed, but the defeasement hadn't formally occurred yet? Prior law seemed to suggest that the actual defeasement, rather than the sufficiency of collections, triggered the decertification. And it was also unclear what constitutes the setting aside of money. If you collect money, is it presumed to be set aside for those purposes, or is there some sort of formal action that amounts to the setting aside of the increment for certain purposes? That was not clear. And then there's ambiguity with PAYGO notes. What if you have sufficient increment that isn't obligated to an outstanding PAYGO note? So PAYGO notes generally only obligate increment as they're paid from a particular parcel or parcel, and make clear that other funds are not obligated for their payment. So whereas, and that's unlike other obligations. Like other obligations, like traditional bonds, are just generally paid from any increment of the district, but the PAYGOs are tied to specific parcels in the district. And so this raises two possibilities: either having to decertify when the total increment is sufficient, even if that increment isn't obligated to, and even if that increment isn't used to pay the PAYGO, or it's staying open until just the increments from the obligated parcels are sufficient. And in the first case, it might have adverse impacts on the note holder, where you might arguably be in a situation where you're telling the note holder, hey, sorry, we have to decertify the district because we have enough money to pay you, but we're not obligated to pay you that money. So we're decertifying now and you're just out of luck, which doesn't seem right. And in the second case, if you waited to decertify the TIF district until the parcels that were obligated had enough increment, now you've got all these other parcels that might be in the district generating lots of increment that's restricted and not eligible to be used for anything. And there isn't there wasn't a partial decertification that was contemplated under prior law. And so neither one of these scenarios is very good. And we're going to look at an example next, but clearly the new language was needed to bring greater clarity as to how this early decertification requirement should apply to PAYGOs. And then lastly, nothing in the prior law spoke to the finer details surrounding when and how the decertification should be implemented in terms of like resolutions and notifications and timing and that sort of thing. So let's look at an example here to help understand this PAYGO note issue. Say you have a TIF district with 3 parcels, and the authority agrees to acquire the 3 lots, install utilities, and convey lot C to a developer for $1, and then they'll reimburse that developer for the demolition costs that the developer will perform in exchange, for the developer doing that demolition and developing that lot. So the city's later going to sell the other 2 lots to other developers. The PAYGO note pays the developer 90% of the increment from lot C every 6 months as the property taxes on that parcel is paid up to until the developer is reimbursed $450,000 or until there's no more increments. And no other revenues or increments are pledged to pay on that note. And so for simplicity, let's say the lot generates $20,000 of increment every year, and 90% of that is going to be paid to the developer, or $18,000 every year. That means that $450,000 is going to be paid off in 25 years. Let's say the authority recoups its costs in year 10 from increment that it received on parcels A and B and from the sale proceeds of those 2 lots. And so at this point in time, through year 10, $180,000 has been paid on the PAYGO and $270,000 remains outstanding. But now parcels A and B will be generating $32,000 of increment every year, and 75% or $24,000 of that is going to be restricted for in-district purposes, but that increment is not pledged on the PAYGO, and there's no other obligation. So essentially that $24,000 every year is going to be unusable. By year 17, there'll be a situation where the in-district balance of increments, at that time it'll hit $168,000 of increments. That's going to exceed the remaining outstanding PAYGO balance at that point in time, which would be, there would still be $144,000 left to pay on the PAYGO. So if decertification was required at that point, because at that point the in-district increment exceeds the in-district obligations, then the developer, if you had to decertify at that point in time, the developer's not going to get his remaining $144,000 because the increments will go away, and all the other money that is from parcels A and B doesn't have to be paid to the developer, so it won't be. And then alternatively, if decertification was not required until only money from parcel C was sufficient, then you're going to have parcels A and B continuing to collect money, and eventually, if they stayed as part of the district for the full 25 years, they would collect $384,000 of unusable increment that would end up having to be returned. And that represents kind of a pitfall, because if they spent any of that $384,000, then that would be a violation of the TIF Act. So both of these scenarios seem troublesome and beg for some clarification. And by the way, if this particular example seemed a little confusing to you, I think there's a better one in the shorter video that we put out. So if this didn't sink in immediately, maybe check out that other video. Okay, so the law greatly expands the 6-year rule to deal with a lot of these issues. And so it's now divided into 9 paragraphs as follows. So paragraph A is going to set the decertification requirement based on a formula. Paragraph B deals with the special provisions related to PAYGOs. Paragraph C has a grandfather provision for pooling bonds. D, E, and F clarify the treatment of some terms. G provides some timing and procedural clarifications. H is a clarification that it doesn't apply to housing districts, and paragraph I deals with how it impacts 2D pooling. So we'll cover each of these. We'll start with the newly reconstituted requirement that's in paragraph A. So it is now a formula requiring that beginning in the 6th year following certification or the year following an extended 5-year period, there are some extended 5-year periods provided in the statute, or sometimes special laws get extensions of the 5-year period. But in year 6 or whatever year follows that extended period, a district must decertify when the applicable in-district percentage multiplied by the cumulative revenues derived from tax increments paid by properties in the district that have been collected through the end of the calendar year equals or exceeds an amount sufficient to pay the following. And before I turn to the rest of this, there's just a few notes here to point out. First, there's no more vagaries about defeasance and setting aside of increment. It's now, decertification is now just going to be triggered by hitting by the formula by hitting a revenue benchmark. Second, there are a couple terms here to note. The applicable in-district percentage is going to be defined in paragraph D and is generally equal to 75% for redevelopment districts, 80% for all other districts, unless there was an election to do the extra 10% of pooling, in which case they would be 65% or 70%. And then this phrase, revenues derived from tax increments paid by properties in the district, is also a defined term in the TIF Act. So it's similar to what we talked about under the admin limit and under the overall pooling limit, where you only use increments that are those clause 1 increments generated from property taxes and not other types of increments like interest earnings or lease and sale proceeds. Those aren't included in doing the formula. Okay, so continuing with the requirement, a district must decertify when the cumulative in-district revenues that we just talked about equal or exceed an amount sufficient to pay the following. 1, any CASA obligations described in subdivision 3, paragraphs A and B, which, by the way, references in-district obligations under the 5-year rule, excluding those under a qualifying pay-as-you-go contract or note. 2, any accrued interests on the costs and obligations in clause 1, payable in accordance with the terms thereof. And 3, administrative expenses falling within the exception in subdivision 2, paragraph C. The reason this first clause here excludes qualifying pay-go notes is because they're going to be addressed in paragraph B. So if a district only has a pay-go note and no other obligations, you're actually going to hit the decertification benchmark right away in year 6. So technically it's going to say decertify in year 6, but then don't worry because paragraph B is going to defer that requirement and cover how pay-go notes are treated. So we'll get to that more in a moment. And then this last clause is referencing the one exception where admin costs might get treated as in-district costs instead of out-district costs. And that happens when all the pooling, other than the admin costs, is done for the extra 2D housing purposes. And so it was a kind of a special provision put into the law to ensure that you could pull the maximum amount. But anyways, this language here just ensures that that amount is included in what's sufficient in the sufficient increment, the amount that the sufficient increment must be able to pay. Easy for me to say. Okay, so in a nutshell, when the in-district share of increment is sufficient to cover in-district costs and obligations, decertification is required, but we'll get to the pay-go exceptions in a moment. So the implications of this and my suggestions for TIF authority are that in year 6, or whichever year follows an extended 5-year period, you will know all your in-district obligations. And you can calculate the revenue benchmark upon which the district must decertify, at least ignoring the pay-go notes and special 2D provisions for a moment. So the how to monitor the 6-year-old video that I mentioned earlier will give you a lot more detail about this process. But essentially, you divide the amount of in-district obligations by the applicable in-district percentage. So for example, if you have a redevelopment district with no election for the 2D pooling, the applicable in-district percentage is 75%. And if you'd identified that you had $345,000 of total in-district obligations, excluding pay-goes, then you would have to decertify when the district reaches cumulative tax increment revenues of $460,000, which is that $345,000 divided by 75%, because when the district collects 460,000, that's when the in-district percentage will equal or exceed the amount of in-district obligations. And so this should hopefully be an easier way for you to kind of target when decertification will be required and to plan for that. But it's a calculation that maybe you should check out each year to be able to stay on track. Okay, any questions so far about this new calculation of when a district must decertify, realizing that I'll be covering the PAYGO issue next?
Nope, I'm sure they're stewing, but I haven't seen any questions
Yeah,
posted yet. But I did just want to say too that I reposted those videos in the chat, and they are also included in the handout that I had sent earlier.
very good. Thank you. All right. Well, let's now talk about how PAYGO notes are treated. Let's start here with the deferral of the decertification. If there's a PAYGO note, the decertification that's required under paragraph A gets deferred until the end of the remaining term of the last outstanding in-district PAYGO note, such that the cumulative in-district revenues are sufficient to pay the other in-district obligations. The deferral shall not extend, though, beyond the maximum statutory duration limit of the district. So, by the way, while I have been covering and will be covering a lot of possibly overwhelming detail here, if you have a district and the only obligation is a qualifying PAYGO note and you've got nothing else, you might just simply recognize right away here that decertification will be deferred until that PAYGO terminates. So you don't really have to worry too much about all the details of these formulas. If you have that, and a lot of districts these days, probably the vast majority, are districts that just have a qualifying PAYGO note and nothing else. And if that's the case with your districts, this formula becomes really simple. You know, there's a formula that's going to say you got to decertify in year 6, but really you don't have to because it's deferred until the PAYGO terminates. So hopefully that cuts through a lot of the questions here. All
I
right.
did just see a question trying to clarify what a qualifying quote
Yeah.
unquote PAYGO note is.
Yeah, and we'll be covering that here soon. But the short answer is a qualifying PAYGO note is one for in-district obligations. Whereas if you happen to have a PAYGO note that was only for out-district costs, that would not be a qualifying PAYGO. But stealing my thunder, that's coming a little later. No problem. Okay. All right. So then paragraph B goes on, though, to require that beginning when the decertification would have otherwise be required under paragraph A, which again would be year 6 if the only thing you got going on is a PAYGO note, the authority must annually remove parcels that will no longer be pledged or subject to a qualifying PAYGO note or any other in-district obligation after the end of the year. Or if you're not going to remove them, then you have to use the in-district revenues from those parcels to prepay any remaining obligations. And by the way, a lot of PAYGO notes don't actually have prepayment provisions. So generally, I think probably more often than not, you'd be removing the parcels. But technically, if your situation is right, you could leave those parcels in and just prepay the obligations. But this is a new requirement now that basically, instead of parcels staying in a district when they're not pledged to pay on anything or not being used to pay for anything, the parcels have to come out of the district at that point in time. So this is a new requirement. Okay, let's look at some examples here. In all of these examples, let's say that the district was certified on June 30th of 2018. So its 5-year-old date is June 30th of 2023. And that makes 2024 the 6th year. And in this first example, the district only has a PAYGO note that terminates February 1st of 2032. So paragraph A of the 6-year rule will initially require decertification at the end of 2024, because at that point in time, you'd have enough revenue to pay all the in-district obligations other than the PAYGO note, because there are none. But paragraph B is going to defer decertification until the end of 2032, because that's the year the PAYGO terminates. But paragraph B will also require here that any parcels that are not subject to the PAYGO be removed at the end of 2024, unless again, you do keep them in and use them to prepay the PAYGO if that PAYGO happened to allow for such prepayments from other sources. So now actually though, one little caveat to this, the parcel removal requirement was made effective only for districts with a request for certification date after the day following final enactment. So it's only new districts that are having their certification requested after May 25th of this year that this is actually a specific requirement for. So for this example, this district, because it was already certified before that date, it wouldn't have to remove those parcels at that point in time. But it's still a good idea. Why would you want to leave parcels in and set yourself up for a pitfall where you've got a parcels that's collecting money that can't legally be used for anything and might just end up getting you in trouble? So even though this parcel removal aspect of the new 6-year rule is only effective for new districts going forward, we would recommend you just think about it for all your districts, because I think it's probably the wise way to go anyway. Okay, let's look at a second example here. Let's say the district only has a $50,000 bond that matures in 2029, nothing else. And the cumulative in-district percent of increments reaches $50,000 in 2027. So paragraph A of the 6-year rule is going to require decertification at the end of 2027. This is true even if the bond payments continue in 2028 and 2029. So the decertification is tied to the revenue benchmark, not to the actual active defeasance anymore. So, and in this case, paragraph B does not apply because there's no PAYGO. Third example here, let's look at a combined example where you have both the same PAYGO from the first example and the same bond from the second example in the same district. Perhaps one parcel is subject to the PAYGO, and increments from all the other parcels in the district are paying towards the bond. What if we reach a cumulative in-district share of increment of $50,000 in 2025? At that point, maybe the PAYGO parcels had generated $20,000 of the increment, which was used to pay on the PAYGO, and $30,000 of the in-district increment has been collected from the other parcels and so far has been used to pay the bond. Well, paragraph A is technically going to tell us that it should be decertified in 2025 because that's when the in-district share of increment equals or exceeds the in-district obligation excluding the PAYGO. But no fear, because paragraph B is going to defer the decertification to the end of 2032 when the PAYGO terminates. And the bond will have already been defeased in 2029. Paragraph B is also going to require parcels to be removed at the end of 2025 that are not pledged to either the bond or the PAYGO, although that's really unlikely because generally parcels aren't pledged to bonds. Generally the whole increment from a district is pledged to a bond. So, so really there wouldn't be parcels to remove at the end of 2025, but if some rare circumstance that might be true. But then the bond, then when the bond defeases, though, however, in 2029, paragraph B is going to require that those parcels be removed that had been pledged to the bond but are not subject to the PAYGO. So once that bond's paid off, and then those parcels that were paying that and are no longer pledged on the PAYGO, they have to come out at that point in time. Again, ignoring the fact that the effective date doesn't actually require it. Except for new districts, but it would still be wise then to pull those parcels out at the end of 2029. And then one last example, similar to the last one, but this time, let's say the PAYGO is going to terminate first. So the PAYGO terminates in February 1st of 2028, which is before a $100,000 bond matures in 2030. And in this example, we'll reach a cumulative in-district percentage of cumulative in-district increments of $100,000 in 2026. So here, paragraph A is going to say that we should decertify in 2026, but paragraph B is going to defer that decertification. And the deferral isn't only to 2028 when the PAYGO terminates. It's a deferral until the PAYGO terminates and the applicable in-district percentage of cumulative revenues is sufficient to pay all in-district obligations. So the deferral may actually extend this district to 2030, or it could be earlier if the amount needed to pay off both was, in 2029 or something. But the deferral isn't just going to defer you to the end of the PAYGO termination. It's going to defer you until the end of the PAYGO termination and sufficient increment to pay your other in-district obligations. And then paragraph B would also require, again, ignoring the effective date issue, that parcels be removed as of 2026. Continue here then. Removal of parcels under paragraph B provision must be done by modification of the TIF plan by the end of the calendar year. So the county auditor also must be notified of the removed parcels by the end of the same year. And we're going to get more into those timing details a little bit later. But modifications that are done for this purpose, assuming they don't contain any other changes that might change the story, they don't require the notice, discussion, public hearing, and findings that are required when you amend, like you do when you create a new TIF plan. This is not a modification that would require that whole larger process, unless, of course, you're making other changes besides just removing the parcels. Okay, so then I would suggest that authorities starting in year 6 check for parcel removal requirements, and when necessary, do the following by the end of the year. Adopt the TIF plan modifications, notify the county auditor, and submit a TIF plan collection form for modified districts to our office via SAFES. So everybody then is informed of those changes. This may actually take some careful checking to see which parcels are pledged on which obligations. There can be parcel changes that occur, obviously, as part of a development process. So be aware that this might not always just be a super quick check. You might have to see what parcel changes have occurred. And so it would be wise to kind of keep notes in your TIF files about that so that you don't have to figure it all out fresh in year 6. And then this requirement should be checked annually as circumstances require. All right, and before I jump into paragraph C, I'll also just note that if at any point in the process the in-district percentage of cumulative revenues exceeds what's needed to pay the in-district obligations, consider returning those unneeded and unusable increments as soon as possible. First, they are restricted and their use would be a violation, so just hanging on to them creates a potential pitfall. Plus, the authority is going to get its share back of the redistributions. So just a note to consider that. And I'll also note that the original bill draft here actually was going to require that that be done, so that if you had in-district increments that couldn't be used for anything, you would have been absolutely required to return those. But that didn't end up making it in the final bill. But could be something that gets considered in the future. All right, now moving on to paragraph C, the grandfather provision. In the course of talking about the 6-year rule with practitioners and cities, we learned that there might be a limited number of authorities that actually issued traditional bonds to pay just for some pooling expenditures, using different assumptions about how the law was to be interpreted. And so to avoid these new clarifications having impact on those bondholders, we thought we threw in this small grandfather clause just to make sure that those existing bonds aren't impeded by the changes here. So if you had increment that was pledged prior to August 1st of this year to a bond or other than, and we're talking about traditional bonds here, not PAYGO notes or interfund loans, then, because normally interfund loans and PAYGO notes are considered bonds under the TIF Act as well. But with this grandfather only applies to the more traditional bonds. if they were used just to finance out district costs, then the requirement to decertify or to remove parcels shall not apply prior to that bond being fully paid or defeased. Yeah, and so my recommendation or implications here is that just review your districts to see if this applies to any of them. Probably won't for most people. It would also be greatly appreciated if you do have one of these, when you're doing your annual reporting, maybe make a comment about that bond and that it meets this grandfather, and that way we'll know that that's the case, and can avoid unnecessary, questions and interactions about it. So gain a little momentum here, I think. So the next three paragraphs clarify some terms. Paragraph D defines applicable in-district percentage, which we've essentially covered already, but just to recap, under the overall pooling limit, the normal applicable in-district percentage is 75% for redevelopment districts, 80% for all the other types. But if the election for the extra 10% of affordable housing pooling is included in the TIF plan, then that reduces the applicable in-district percentages by 10%. And so I listed out those four possible scenarios here, but I won't read it to you. So, all right, and paragraph E then defines the term qualifying pay-as-you-go contractor note. We already looked at this and we had the question, what makes it a qualifying one is that it's for in-district obligations. So a pay-go note that's established after the 5-year period would not be a qualifying pay-go note, and there would be no deferral of the decertification requirement under the 6-year rule for that kind of a pay-go. And then paragraph F provides two clarifications of what is included when referencing the cumulative revenues in paragraph A. The first is the reference to the through the end of the year. That shall include any final distributions that are made to municipalities or authorities in the following January. The property tax calendar requires property owners to pay first half taxes in May, and those are usually distributed in May and July. Then the second half property taxes are due in October 15th, and those are typically distributed and kind of end of November, early December. And then any remaining taxes that and their corresponding increments that are received through the end of the calendar year, if there are any, they get distributed by January 25th, and those should be included in this measure. And we'll get to more on the timing clarifications when we get to paragraph G. The second clarification of the cumulative revenues relates to the disposition of returned increment. The cumulative revenues should be determined after subtracting or excluding any returns of excess increment or returns made to remedy the receipt of increments in violation of the TIF Act. So that's kind of working the same as we talked about for both the admin limit and the overall pooling limit. We're again using the net amount after those kinds of returns. Okay, so going on to paragraph G then, this provides some of the timing and the procedural provisions that are related to the required decertifications. It distinguishes between instances when the decertification has been deferred because of a PAYGO versus decertifications that occur without the deferral when the threshold of revenues collections is reached. When there is no PAYGO deferral, an authority must decertify as soon as practical, but no later than the January 25th final settlement date in the following year. So potentially collections could be super close, where an authority might not know for sure whether they've hit that threshold until they get that last January settlement. And actually the county will know by earlier in January, so you could communicate with them if you really are coming down to the last few pennies. But you want to take action as early as possible. But because of this possibility that things are coming down to the final settlement, we stretched out the deadline to this last possible minute as to when you would have to do the decertification. But it's important to do it as early as possible, because some counties were telling us that December 31st is practically too late for them to stop increments in the following year. And some of them insisted that January 25th would just be too late and they wouldn't be able to stop increment calculations for the following year. So really, you want to do this as soon as possible is really important here, rather than waiting till the absolute final moment. Um, the decertification is done by resolution stating that the decertification is effective for the end of the year that's identified in paragraph A, and it's best to communicate it to the county auditor immediately after you adopt that resolution. When there's a PAYGO that defers the decertification until the PAYGO terminates, those dates are often attached to dates earlier in the year, like your February or August payment dates, um, or whatever months get cited in a PAYGO note. So because there shouldn't be this issue of, well, we need to wait to the last minute to find out if we've hit the threshold or not, because you should know coming into the year that that's the year that you need to decertify. The deadline is just December 31st. And again, it is better to do it earlier than that whenever possible. So the decertification again should be by resolution, effective for the end of that year, and should be communicated to the county auditor as early as possible. Paragraph G also includes two provisions to deal with instances where the timing was such that the following year's calculations could not be prevented. So if you weren't able to notify the county in time, or the county was too far along in their processes and couldn't stop increment for the following year, um, then one provision here allows the county to skip having to send it to you, and to have you send it back before they redistribute it. It allows the county to skip straight to the redistributions without, first having to send it to you and then getting it back. But however, if they do proceed with distributing it to you, then the statute is telling you that you need to return it back to the county, so then the county auditor can redistribute it as appropriate. Um, and then these are the returns of increment that I was referring to earlier when I was talking about the admin limit and the pooling limit, and how those are determined net of amounts that are returned back to the county auditor. So if you're returning these amounts, these are not actually tax increments anymore. So they just need to be returned and then they get redistributed. Okay, so my suggestions on this point then is that I recommend that authorities take a look each year, perhaps about now in the early in the fall is a good time to be doing this, and just identify for each district whether a decertification is required or might be required, and then you can prepare and pass a decertification resolution and notify the county auditor and fill out a confirmation of decertified district form and get all that done by the end of the year. Um, and this will avoid that, doing so now kind of will avoid you having to, frantically do all this stuff at the end of the year, and taking last minute actions to try and get these districts decertified when that's required. And being able to do so in a timely manner prevents your taxpayers from having to pay, the unnecessary extra tax burdens for one more year because it wasn't stopped in time. So, all right, any questions about paragraph G or what we've discussed so far?
Um, there was just kind of a clarifying question from a new administrator. And by the way, I want to point people to the resource sheet again, because there is, if you're new to TIF, we did do a webinar earlier this year for, new people and new administrators. So you might want to check those out. But anyway, his question is, the way the PAYGO works is that the developers pay the increased taxes and then the cities pay back the difference between the original tax base and the new tax base. Does that sound right to you?
Yeah, pretty close to that. So usually it's so like if the original value were $10,000 and the new value is $100,000, you got a $90,000 of increase. So tax increments are going to be generated on that 90,000. And usually the way the PAYGO notes are written is that they get refunded 90% of their tax increments from the parcel. So it's not all of the increase. Usually it's some PAYGOs say 80%, some say 75%. I think most of them probably say 90%. So there can be a variety. It depends on how the PAYGO note was structured. But yeah, essentially, the way PAYGO notes work is they say every 6 months the city will make a payment to the note holder, for a percentage of the increments that were received in that last 6 months. And that's how the PAYGO financing generally works. So good. All right. Well, we'll move on here. Paragraph H, just simply, as I mentioned earlier, says the 6-year rule does not apply to housing districts. Again, housing districts don't really have pooling because, all basically you can only use increment from a housing district for affordable housing, and generally those affording the use of increment for affordable housing is defined as an in-district activity, no matter where it's located. Usually, generally. So anyway, the 6-year rule doesn't apply to housing districts. And then our last subject here is paragraph I. It's the final component of the 6-year rule. And the purpose of this paragraph is to help ensure that the extra pooling for 2D housing will always be available as an extra 10%, and that extra percentage won't get cut off by the early decertification requirement or by the parcel removal provisions. So to be clear, this does not mean that the initial estimates for the district about how much pooling could be done is being protected. When a district falls short of reaching the amounts that it had projected, but it does ensure that the 10% share or the 35% share in some cases is available for that purpose. And so I'll further preface this by noting that this provision is a bit tricky, but it won't apply to most authorities. So the election to pool extra for housing isn't an option that most districts have chosen. So if you don't have any districts that have this election for the additional pooling for 2D housing, you could just drop off at this point, and we're kind of done with the content that might apply to you. But for those of you that do have this districts with this election, or for those of you that just want to stick around and understand, we'll dive in here and take a look. All right. So this provision provides that if an authority has made the 2D election in the TIF plan, then the requirement to decertify under paragraph A or remove parcels under paragraph B shall not apply prior to such time that some criteria are met. Decertification or parcel removal requirements shall not apply prior to such time that the accumulated revenues derived from tax increments paid by properties in the district that are eligible to be expended for housing purposes described in subdivision 2 paragraph D equals or exceeds the lesser of two amounts. Before I describe those two amounts, note that the phrase revenues derived from tax increments paid by properties in the district is again that defined phrase that refers to clause 1 increments that we've already discussed a few times now. And the reference here to eligible to be expended for purposes described under subdivision 2 paragraph D is a reference to that 10% for affordable housing, which could be as much as 35% in a redevelopment district or 30% for other districts if all the pooling is being done for the affordable housing purposes that are described in 2D. And that's the situation. And if that were the case, then the admin costs get treated as in district. So decertification or parcel removal does not apply prior to such time that this accumulated share of revenues that can be used for 2D purposes exceeds the lesser of the amount the authority is permitted to expend for housing purposes under subdivision 2 paragraph D, or the amount authorized for such purposes in the TIF plan. Now, again, that latter amount is often not going to be the lesser of the two amounts because TIF plans often overestimate increment. But when it is the lesser amount, it should be really easy to identify. This other amount of what's permitted might be difficult to precisely identify, and I'll expand on that in a moment. But first, I'll note that this paragraph also requires that any increment collected after the district would have decertified under paragraph A or from parcels that otherwise would be subject to removal under paragraph B, absent this paragraph, shall be used solely for housing purposes described under subdivision 2 paragraph D. So this delay cannot be used to maximize other pooling. It just helps expedite the protect the pooling for affordable housing in subdivision 2D. Now, as I mentioned, determining this amount the authority is permitted to expend for housing purposes under 2D as an amount rather than as a percentage might be difficult to precisely identify. An authority might be tempted to kind of analyze new projections each year or in year 6 and following years, and based on actual activity. But any projections like that are just projections, and again continue to change over time as increment increases or decreases relative to projections, or as administrative expenses fluctuate. And therefore the timing of the required decertification, um, when the revenue benchmark is reached, may change as time goes along. And so that makes for a difficult assessment. But we do offer a recommendation for how to determine the amount that the authority is permitted to expend for housing purposes under subdivision 2D. And this recommended method isn't codified, and there maybe are other alternate amounts or other ways to identify that amount that might also be justifiable. But this is a good method that makes understanding and applying this provision much easier. First, identify the revenue benchmark point at which decertification will be required. So do this by dividing the in-district obligation amount, which again, you should largely be known as of year 6, and divide that by the applicable in-district percentage as we discussed earlier. And then second, multiply that revenue benchmark by the maximum pooling percentage to identify the total authorized pooling amount. And then subtract from that authorized pooling amount any amounts that you're pooling for other purposes that aren't 2D. And that way you should be able to identify pooling allowed for 2D. And this should be a fairly simple way to identify, this protected amount that's being protected by this paragraph. Let's look at an example, because just saying that is a lot to take in. Let's look at the TIF plan components here on the left and the reality as of year 6 on the right. The TIF plan indicates it's a redevelopment district, so 25% can be pooled. It contains the election for 2D pooling, which adds 10%. The estimates project that $1 million of increment are going to be received, and 550,000 will be used for in-district public improvements, and 100,000 will be used for admin expenses. And in this case, that 100,000 is going to get treated as in-district under that rare exception, because the plan is to spend 350,000 on pooling solely for the affordable 2D housing. So they don't plan to do other types of pooling. All of the pooling that they're going to be doing is going to be for the affordable housing provisions under 2D. So there are 2 parcels in the district, which was certified in 2018. So year 6 is 2024. The statutory maximum duration or the required decertification date would be in 2044. And in reality, by year 6, the only in-district activity is a PAYGO on one of the parcels that was established for 424,000, not the planned 550, and the PAYGO terminates in 2040. And new projections expect that the actual increments will be about 800,000. So 424,000 or 53% will be spent in district. $80,000 or 10% will be used for admin. And then that means 2% or $16,000 is going to have to be returned to the county auditor to meet the minimum in-district expenditure requirement under the overall pooling limit. So the projection is that 280,000 or 35% will be used for the 2D affordable housing. And remember, these are still just projections in year 6, that are subject to change. But at this point, we'll know that parcel number 2 needs to be removed. But when does it have to be removed? So paragraph A would have had the district decertify in 2024 because there's no other obligations besides the PAYGO. But paragraph B says the decertification can be deferred until 2040 when the PAYGO terminates. Paragraph B requires parcel number 2 to be removed, but paragraph I now says that the decertification and parcel removal can be delayed until the accumulated revenues eligible for 2D pooling, 35% in this case, equals the lesser of the amount permitted for 2D. or the 350,000 identified in the TIF plan. And paragraph I is going to require that any increment from parcel number 2 be only used for 2D purposes. So in our example, how do we determine the amount permitted for 2D purposes? The new projections expect 280, but that's subject to change. Our recommended approach is to identify the revenue benchmark. We know that the in-district obligations are 424,000. If we divide that by 55%, we ensure that there's still 10% that can be used for admin. Or we could add the $80,000 of admin to the 424 and divide it by 65%. But either way, we get a revenue benchmark of 770,909. And so we know that when the total revenue hits that amount, that's when this district is going to have to decertify. So if we multiply that total tax increment revenues by the percentage that's permitted for 2D, 35% in this case, you get 269,818 as the more reliable amount that will be permitted for 2D housing compared to the $280,000 projection. So this 269,818 is lesser than the 350 that was identified in the TIF plan, and parcel number 2 could be kept in the district until the poolable dollars collected equals approximately 269,818. And then any subsequent increment from parcel number 2 has to be used for those 2D purposes, so that it have to be accounted for and tracked accordingly. But yeah, so that's the simple way to figure this out. And I do understand that this is complicated. It just is. But if you're going to take advantage of the extra pooling for housing and you want to make sure you get every possible dollar for that purpose, then this is just the extra attention that's needed to keep track of that and to make sure you can maximize that 2D pooling. So my suggestion and the implications for this provision are an authority should annually assess the need for parcel removal or decertification by rechecking whether sufficient increment has been received for pooling permitted for housing purposes under the 2D election. And remember, you don't have to worry about this for districts that don't have such an election contained in the TIF plan. And it would be a good idea to include comments on annual reporting forms or to check with us in the TIF division when calculations might be close or unclear, and provide a reasonable assessment as to why removal or delayed decertification is judged to remain appropriate. And of course, we might inquire if we think that actions are timely or have been missed. All right. Well, that then concludes our review of the 2023 session law changes. And thanks for participating. Please feel free to contact us with any questions you think of, or if you have suggestions for additional training. Have a great day.